with another video live stream sort of setup. And what we're going to talk about today is, well, the common scenario. Oh no, my portfolio is blown. Like one of those thumbnails, right? Like they'd be acting like it's Halloween. The point I'm trying to make is that there's not a reason why you should give up on building a portfolio just because you blew the first 10. And I'm going to explain why. If you have been learning the whole time and you didn't fail the exact same way, it's just how you fail. You have to limit that to cheap lessons. So, in the long run, it might not be cheap, or in the short run, depending on how much you have lost. But the key common thing that has happened so far in these markets is everybody tried to price in altcoin season ahead of time, and everybody was constantly front running. Because everybody was constantly front running, we had this situation where if you kept front running, basically you were front running something that was never going to happen, and you just got took as exit liquidity, which is, it's not the best. You don't want to be exit liquidity on purpose, but it's different when, I'll give you an example. The average retail person sees altcoins and stocks in the same category. And you might be like, no, that's not true. I don't think that altcoins and stocks are in the same category. Well, they kind of are, because the S&P 500 is carried by 7 companies and the rest of them are zombie companies. So there's that. When you look at it from that aspect, the only difference is the legal protection you have when you buy a security versus something like a cryptocurrency that's still being regulated. So treating a regulated market the same as an unregulated market really is the problem. In order to actually make it, you have to actually have that investment maturity. And I'll keep it honest, some of you guys, including myself, you're gonna have to say that long-term portfolio goal that you had that just got lost, even though that was real capital, real money, real risk you put on the table, and you took that risk and it didn't play out. That's just how you have to see it. It's not about gambling more money and gambling your way out of poverty. That's not what we're talking about. We're talking about a more fundamental analysis when it comes to what's actually happening with these narratives in the crypto space. It becomes this, okay, what's next? Okay, what's next? Instead of just taking what's in front of you and saying, like, you know what, I messed up. I could have ran off on alts. I didn't take profit. Let me just try to re educate myself and try to learn about Bitcoin again. Actually, let me see if I can. Where's my microphone at? Okay, I'm gonna try to plug this up. Sorry, I always forget to plug it up. Hopefully the audio quality should be a little bit better. Okay. Okay, so hopefully I'm not going to be recording this video again. I'm just going to leave the microphone right there. But basically, again, is everybody was trying to front run. It didn't play out, and then people were starting to lose their jobs, including me. Like, I just got fired randomly, so I'm like, great, now, because the problem isn't necessarily the portfolio, it's the measure of the portfolio against the measure of risk, against the economy, against other assets, against opportunity cost, right? And when you don't take in those factors, you're going to get humbled in these markets when you have to restart your portfolio for like the 8th fucking time. That's me right there. Have to restart your whole portfolio again. Whoop-de-doo. Now you got to climb back up to 1K. Great. Fuck. It's fine though. It's fine though. Because it's like, it's all about how you view it. You can either view it with the most negative point of view, which is a complete fucking waste of time, right? Or you could still humble yourself and say, you know what? I'm just gonna wait for this Bitcoin train to take off, and that's it. I'm not gonna gamble on alts. Yeah, it's a boring strategy, but it's a strategy that I've noticed would have kept me safer more times than not. So if you're gonna get involved with any of this, how you get involved, you have to choose which risk metric is actually, what you're taking versus viewing it as a wrong, versus viewing whatever altcoin, crypto, Russell 5000 stock like you're evaluating the Mag 7. That's the problem. When you take these small cap stocks and small cap cryptos, that, there's definitely less small cap cryptos than there are small cap stocks, because usually the small cap stocks are like a billion, $2 billion maybe, but they don't have a lot of liquidity locked up in them. So when you're viewing any asset in these markets, you have to actually, you can't put it in a basket of personal risk. That's something I used to do, where it would be like, okay, so there's this basket of risk. I want to go low risk. And out of all the altcoins, what's the lowest risk? No, you actually have to go to a safer sector. I wish I had somebody tell me that, when I was, whenever I had profits, like, move it over to a safer sector at least. At least move it over to a safer sector outside of the basket of crypto. That that advice alone, I hope, is going to save people a lot of trouble, because by the time it takes for you to have learned that lesson, if you don't have the right cash flow, you're going to be priced out for multiple years on end. And thank God I'm not completely priced out, but that's what it comes down to realistically. It's like, if you're constantly hopping in and out of Bitcoin, even during its bear market years, you can get wiped out off of one wrong guess trying to time everything. You know what I'm saying? I'll give you an example. The 2022 15.4K bottom. Everybody was calling for 12,000, 11, 10, 9 as the lowest if you were trying to be reasonable. Um, and the problem with that situation is we were so close to the bottom, everybody basically missed out on the next 100% rally up to $30,000 if you were trying to guess and play games and do this and that, and then it's 100% off the bottom, and it's this and that. Like, it's not about how long it takes for you to get to a specific number of your portfolio. It's just the way you allocate money will show itself while your portfolio is either thriving or dying. And if you're gonna have a portfolio that's constantly dying, like if you're constantly getting reset to zero, in my opinion, that includes spending money. Because it's a little bit better if you spent the money and that's why you went to zero. It's a little bit better, but it's not better in advancing your financial, success, because you're still burning through more dollars than what you're accumulating. And if you're kind of like me in the past, where you based on what you were currently spending in that moment based upon potential future returns, that's not a good way to allocate your current portfolio, because you're investing based off unrealized proxy. Meaning that, like, if you're going to be investing, right, like, I'll give you an example. A good way to invest in, not financial advice, I was about to say something like that, but not financial advice, do not invest unless you're ready to lose it all. But something that I noticed is, okay, with Bitcoin and silver, that's a nice unrealized proxy. Bitcoin and gold, that's a nice unrealized proxy. When you take it two steps forward too many, like, I'll give you an example. You got your altcoins and you're spending based off that unrealized proxy of altcoins to USD. You're you're overvaluating what you would actually be spending, off your capital gains or short-term capital gains. However your stuff is structured, you're overvaluating the potential return before you even realize it. And because it's so high risk, like, it's different when you have an unrealized proxy between two common assets, like Bitcoin and gold, silver and titanium, Bitcoin and titanium, stuff like that, where it's not going anywhere, but it's not just based upon the actual, the aggregated potential return, right? If you're taking too much risk and you're getting all these returns, at least tell yourself that you are taking a huge amount of risk. I'm not gonna say you, but I would tell myself, okay, keep it 100 with the risk. This can go left at any time. It's still gambling like that, but where you take it away from gambling, a person, they just have to literally become a more mature investor and say less returns, less risk. And that's honestly, honestly, I wish somebody would have told me that. I wish, because coming across that information when it's quiet, it's not going to be easy to find the information that's quality when it's good because there's so much noise being made. You look around now with Bitcoin and these cryptos, and because everybody's getting priced out on both sides, you're at least seeing um like the kind of proportional risk you want to be not you I would be taking. I'll give you an example, because if you're investing in something where you're not going to be able to get sent to zero without margin and without altcoin capital and without options, then you're becoming a more conservative investor, which is, the safest way to go about this, because all the money that you spend during these risk metric phases where you got, unemployment skyrocketing, you got the VIX doing whatever, you got the DXY doing whatever, you have to track the S&P 500 with Bitcoin and with the NASDAQ. It does become a lot. It does become a lot, but you have to come up, well, not you, a person has to come up with that kind of system that's going to stop them from, what's the word? That's going to stop them from losing as much as possible, because it's not about how much you can earn, it's about how much you can keep. And if you don't understand what I'm saying, then you probably are going to get sent to zero a couple more times, which is fine. I think as a trader slash investor, you have to have that flexibility no matter what's going on with your portfolio. You just have to. I'll give you an example. The thing with Ethereum right now, it's not good R&R. It used to be good R&R, but now just the way it's performing, it's not good R&R. Yeah, it can still head up towards 7, 8, 9K, but who really has time for that? Like, you know what I'm saying? Like, we just fucked up one of the biggest setups of the year, and you expect me to stick around for the rest of it? No. So you have to have that line in the sand that you personally draw with anything, and it could be in the form of limit orders. If you're a bit more bold and you're actually watching these markets, it could be in the form of just manual limit orders, which I don't really recommend, but they're useful because when you're keeping track of the price manually, you don't get stopped out on your trades as easily. But if you like, I'll give you an example. Like, if you're leading the portfolio in Bitcoin, there's no reason for you to be having constant stop losses because you're evaluating your portfolio in Bitcoin. Now, if you're in something that's too volatile to say keep up, like in the way where it's like, okay, we have this volatility here with Bitcoin. Yeah, that's going to be volatile in USD, but because I'm evaluating every stock in Bitcoin and not just USD, it gives you, in my opinion, not you, but for me, it gives me a little bit more room to breathe because I don't really believe in USD like that. Like, like I think the most bullish thing about USD is CRCL, but besides that, everything is just cooked because unless they can monetize the debt, we are going to be heading into hyperinflation. So me evaluating a percentage of my portfolio allocation constantly in something that's devaluing, that doesn't make sense to me. So I'll leave it there. Hopefully, if you gotten sent to zero before, you're not, gonna do anything too harsh. But yeah, that's it for this video. I'll see you guys later. Gotta, I gotta end this. Okay, I'll see you guys later.